Hey, I'm Jason with Northern Equity Real Estate.
And I'm Garrett. Find me at Mortgage by Milan.
Today we're talking about interest rates again. They're continuing to rise.
Right.
We're at 5%. So you really got two options with interest rates. Number one, you can cry about it and be upset because you didn't buy a house sooner. And lock in a rate when they were in the threes. Or you can take action now because I think we're anticipating some more rate increases.
Right. So it's looking like, there's about like what the talking heads are saying right now is there's about a 98% chance that the end of March we should see another quarter point raise, and then a 74% probability that mid-July we're going to have another quarter point raise.
So quantify a quarter point. How much money does that look like on, say, a $300,000 or $400,000 loan?
Well, just because the Fed raises their rates a quarter point doesn't mean it exactly equates to how much a quarter of point is going to be raised on mortgage interest rate. So so it could take a couple days, it could take a couple weeks. The banks could decide not to raise theirs. There's a lot of moving pieces, and I by no means am a wizard with that stuff. I'll admit to that up front.
Mm-hmm.
But the deal is that anytime the Fed raises their rates, it's going to be directly, there's going to be a direct correlation with how mortgage rates react to that.
Okay.
So a quarter of a percent, let's say, I was just doing some numbers really quick, and if you're buying a $400,000 house and you go from 5% to 5.5%, it's about $100 and some change.
Per month on your monthly mortgage payment.
Per month on your monthly mortgage payment. So if we're looking at the possibility of there being more hikes in interest rate, what's that going to end up doing? You're going to have to now your loan amounts that you qualify for are going to be less by a certain percentage.
Another thing to consider also is it's not just that $100 per month. It's over the life of the loan.
A lot.
You're paying thousands and thousands of dollars.
Tens of thousands.
Yeah.
So and then another thing that I think we should think about, and you might be able to speak to, is that when the time of the year comes where people are starting to list their homes.
Sure.
And right now, at least our current market around the greater Sacramento area, Northern California, there's not as much inventory, right?
Mm-hmm.
So this time of year that comes up, springtime, they start listing a bunch of houses, and there's more people wanting these houses. And so what's that do?
Yeah, so obviously it's a supply and demand, function of supply and demand. So as the inventory increases, we're going to have more options for buyers, but we're also going to have more buyers. And I think where we're at right now, and one of the things we've been talking about in this office, is the influx of people that are coming from the Bay Area. So you already have a tight inventory. We're not building new homes, and there's a tremendous amount of people who are coming in from San Francisco, San Jose areas. So our strained housing market's going to continue to see strain. And then you have this issue where there's a lot of people coming out of 1031 exchanges and other financial incentives where they need to buy real estate.
Mm-hmm.
When they need to buy real estate via 1031, or you have people who just really want to move to the area and they have cash, then what they're going to do is they're going to raise that purchase price. And when they raise that purchase price, they're also going to be able to put more cash into a deal. So say you're FHA or first-time buyers and you have 0% or 3.5% down, you can't compete when the purchase price goes above appraised value.
Right.
Because the bank won't finance the loan.
Right.
And any seller is going to want to take the best offer they can, which is more cash, higher list price, and no appraisal contingency.
Yeah, no contingencies. So, I mean, there really is some stuff brewing that, while it's still a good market, it's if you can get in earlier, I would think that it's probably better. And I'm not trying to the sky's falling or anything like that, but there's opportunities now where rates are higher than they have been over the last 6 months or whatever. But at the same time, if we can get in a little bit sooner rather than later, I don't think there's going to be any end to interest rates raising and housing prices raising, at least in the Northern California
And
area.
the reality is we never come from a place of push sales. So this is just information that we're studying the markets, we're studying what news is coming out, and there are planned rate hikes, and there's a strong probability that we're going to see an increase. So at the end of the day, you can make a decision to purchase now and try and lock in as good of a rate as you can, and again, stop crying about the fact that you didn't buy a house when they're in the threes. Or you can say, oh, I want interest rates to go back down before I purchase, and then there's a chance that you're paying another $100, $200 a month because you waited.
Right, exactly. So, I mean, there it is.
Yeah, we appreciate you checking in. Please, as always, ask us any questions you have. Leave them in the comment section below. DM us, and if you have any specific real estate or mortgage lending needs, we're here to help.
Thanks.
Thanks, bye.